Okay, so hopefully you can see the handout, two powerful market forces. Going to slide number 2. There we go. Market is caught between two powerful forces. The virus appears to be picking up speed and the economy appears to be shutting down again. Let's call this the W. Let's call this the W. The W seems to be possibly in play with the economy. At the very least, we could say, and I'll run through some charts with you in a second, that the pace of reopening the economy has definitely slowed in the last few weeks. Now, you wouldn't know it by looking at risk markets, especially the stock market. They keep hanging in there, keep going up, especially big cap tech stocks, the disruptor stocks, if you will, the FANG plus Microsoft. Maybe you want to throw in Tesla and NVIDIA into that group. By the way, those 8 stocks right there are like 27% of the S&P. So the market is caught between the economics, which is dicey at best, and money printing. And for the moment, money printing is prevailing. As I'll go into the call, what ends this? The bond market ends this. As long as the bond market continues to stay, and as I look at my screen, it's 64 basis points plus or minus a couple of basis points about that, then we could keep printing money, we could keep borrowing, there's no problem. When the bond market rejects it, and that is higher interest rates, then this game is over. What gets us to higher interest rates is if inflation returns. Now, I'll give you a quick conclusion here. There is no good measure of inflation expectations. All the measures we had pre-pandemic, tips, break even, surveys, and the like, they were nebulous at best, in order to measure the expectations for inflation. Post-pandemic, they're not good. They're just not good at all. And in the case of tips, break evens, the Fed's the biggest buyers of nominals and tips. They'll set it wherever they want to set it. It's not a measure anymore of where we think inflation is going to be. So keeping that in mind, if inflation returns, that raises interest rates and that ends the game. And then finally, if I got a couple of minutes, I'll try and keep moving along. Just to show you some stuff about the election. Biden is leading. Biden is anticipated to win, but I think this election is a lot closer than people think. It's all about 10 swing states. It's not about the overall national elections. I'll just leave it at that and we'll go from there. All right, let's talk about the economy. Let's talk about where the state of the economy is. I've only got a couple of charts on this because I thought I only need a couple of charts. So I'll start with the Citibank Surprise Index. For those of you that are aware of it, if you're not aware of the index, in 10 seconds, what the surprise index does is that it measures actual data versus expectations. So when a data point comes in above the consensus, it gets positive points. When it comes in below the consensus, it gets negative points. That's the surprise index. The surprise index has shot out to new all-time highs. They started the index in 2003, and that's what you're looking at right here, new all-time high. Now, the surprise index is available on out on the internet. It's available on Bloomberg for free, and everybody looks at it. The surprise index is made up of two subcomponents, the data change index and the consensus change index. So they measure the data itself and they measure the consensus itself, subtract the two, and you get the surprise. You have to ask Citibank for permission to get that, or pay Citibank to get it. Fortunately, they allow me to have that, and that's the second panel down here. And so this is what I look at is the data change index. The data change index actually shows you what the economy is doing. To read this chart, look at 0 on the chart. That means that the economy is at the same level it was a year ago. So you're measuring it versus a year ago. What's important here is, are you above or below 0? We are way below 0 right now. The economy is way worse than a year ago. That I don't need a fancy statistic to tell you that. What it's also showing is that the economy has been rebounding, yes, but it's still well below 0. It is getting less bad, or maybe I should say less terrible. So that really what this shows is the economy is terrible, but it's getting less terrible. It's got a long way to go before it gets back to some kind of level that would approach normality. And the surprise index only tells you that these terrible numbers are beating consensus because the economists are way too pessimistic. That's all. So don't confuse this with the economy is doing well. I know a lot of